They didn't break out. They baited you. This morning, silver ripped straight into the 83 zone, lit up every alert on your phone, and then right at peak, excitement got yanked through a trap door. Price sprinted to about 82, 75. Then it got slammed down into the high 78s. Same day, same session, same chart. And if you chased the headline, you did not buy a moon ticket. You became exit liquidity. Welcome to the Wednesday flush. No greetings, no warm-up. Facts first. A major bank dropped a shiny forecast on the street. Silver could reach the high 30s in the next couple of years. The internet translated that into silver is unstoppable. Blogs screamed triple digits. Social feeds turned it into certainty. So retail rushed in, late, loud, emotional. And the market did what markets do. It smiled and handed you the bill. Now here is the part most people miss. Today was not random. It was a play. A clean, professional, old-as-time maneuver. Sell the news. They did not need the forecast to be true. They needed it to go viral, because viral equals buyers, and buyers equal an exit ramp for big money. We are going to unpack exactly how this works, why the 83 level matters, where the real danger zone sits, and what we do from here without donating our position to the casino. Educational only, we manage risk. Let us start with the mechanics. Imagine you are a whale. You bought heavy down near 60. Maybe you stacked futures, maybe you loaded ETFs, maybe you built a physical position through a desk. Now price is flirting with 80. You are sitting on a monster profit, but you cannot just sell. If you dump your whole size, you crush the price while you're still holding the bag. So you need something first. You need a crowd. You need a stampede of fresh buyers to absorb your selling. And crowds do not show up for spreadsheets. They show up for stories. This is why headlines appear at the worst possible moment. Not because analysts are evil geniuses, but because liquidity is a hungry animal. When the crowd believes the next candle is guaranteed green, they hit market buy like it is a fire alarm. That is when the whale says, perfect. They sell into your greed. They sell into your hope. They sell into your certainty. And the chart prints the same ugly signature every time. A spike, a stall, a dump. So when silver touched the 82 to 83 ceiling today and got rejected hard, that was not bad luck. That was distribution. Metal changing hands, weak hands letting go, strong hands loading. Now watch this. Why did it happen? Right around 83? Because charts have memory. Markets do not forget where they hurt people. Late December, silver tagged roughly 83. 7 and got slapped down. That became a scar on the chart, a public scar. Traders see it, algos see it, banks definitely see it. So the second we approach that scar again today, near 82, 75 sellers lined up like bouncers at a club. You are not getting in. That creates a ceiling. And when a ceiling forms, two things happen at the same time. Retail buys the breakout, pros sell the test, same candle, opposite behavior. That is why it feels like betrayal, because it is, not personal, structural. Now, does that mean the bull move is dead? Not automatically, but we need to treat 83 with respect. It is a gate. It is a wall. And walls do not fall because we want them to. They fall when there is enough force, enough capital, enough conviction, enough time. Here's the mistake most people make. They see a bullish number, 39 in a research note, or 300 on a meme, and they assume the timeline is the same as the target. But markets punish timeline confusion. A bank can say over the cycle. A blog can scream this week. Your leverage account hears today. And that mismatch is where accounts die. If you are trading minute to minute, today's flush is lethal. If you're positioned for a multi-year monetary and industrial squeeze, today is noise. Painful noise, but noise. So we separate the facts from the story. Fact, price ran to the 83 area and failed. Fact, it dropped fast into the 78 area. Fact, we are seeing classic sell the news behavior. Interpretation, the market is shaking out late buyers before the next leg. Possible risk, the rejection creates a bigger pullback if support breaks. Now we get tactical. Where are the lines that matter? First line, the 82 to 83 ceiling. That is the prove it zone. If price cannot reclaim it, rallies will keep getting sold. Second line, the high 78s. That is where buyers started catching the fall today. It is the first trampoline. Third line, 75. That is the real battlefield. Old resistance often becomes new support. 75 was a ceiling for a while. If silver closes the week above 75, the bigger structure stays intact. If it loses 75 and stays below, the market is signaling deeper digestion. Not the end of the world, but a different game. And here is our first engagement question. If you had to pick one number to watch, which is it? 83 or 75? Drop it in the comments because that answer tells us whether you are trading momentum or positioning for the macro. Now zoom out one layer. Silver did not move alone. Gold slipped too. Not as violently, but it leaned red. That matters because silver is the high beta cousin. When gold sneezes, silver flips the table. So if gold is holding major support, silver's drama can be a mood swing, not a heart attack. But if gold starts breaking down hard, silver can turn from volatile to vicious. So we watch the anchor, not just the rocket. Now let us talk about the banknote. This is where people get emotional. Why would a big bank publish bullish research right at a top? Exactly. That question is the whole video, because banks do not publish notes for your benefit. They publish notes into a market ecosystem, and the ecosystem rewards timing. A bullish note does two things at once. It changes narrative, and it creates flow. Narrative is slow, flow is fast. Narrative is the pension committee reading a report. Flow is the retail crowd smashing buy at the open. Today, flow dominated. The crowd chased. The pros sold. But narrative is still sitting there like a seed, and seeds matter. Because large pools of capital need permission. They do not buy because a friend texted them. They buy because they can point to research when someone asks why they did it. That is how committees work. That is how careers survive. So even if today's candle was ugly, the fact that a major institution is talking silver in bullish terms is not nothing. It is a signal, not of tomorrow, of the direction of conversation. And conversation moves money. Now, the cynical angle. Why would the big machine turn positive? One possibility. Positioning changed. If an institution reduces short exposure or flips net long, suddenly bullish research is not dangerous, it is helpful. We cannot see every book in real time, but we can watch behavior. And behavior today looked like use excitement to distribute. That does not mean sell forever. It means sell here. There is a huge difference. So what do we do with that? We stop treating headlines like prophecy. And we start treating headlines like tools used by smart money to move you. Here's the second question. Be honest. Did you buy because you understood the thesis or because you feared missing the move? That difference decides whether you panic sell or hold steady. Now let us get into the psychological warfare. After a flush like this, the media loves to throw gasoline. Bubble popped, speculators burned, silver crashes. They never show the full context. They will not tell you silver is still up big versus the levels where whales accumulated. They will not tell you that volatility is part of the asset's DNA. They just want your click. And the market wants your shares, so they work together without even coordinating. One sells fear, the other harvests it. Now, what is the clean way to survive this? We do three things. We manage risk, we control timeline, we respect levels, risk first. If you're leveraged, today is a warning shot. Silver is not a gentle asset, it is a chainsaw. And if you hold a chainsaw with slippery hands, it does not care how smart you are. So our rule is simple. No forced selling. No margin games that can liquidate you on a wick. If you are in spot or physical, you have time. If you are in leverage, the market owns your throat. Timeline second. If your thesis is multi-year shortage plus monetary reset, then a Wednesday dump is a speed bump. If your thesis is, I need this to go up this afternoon, you are gambling. We are not gambling. We are measuring. Levels third. 83 is the lid. 75 is the floor that matters. Between those is chop. Chop is where patience gets paid and impatience gets punished. So, what is the most likely path? Two scenarios. First path, bear trap. Price holds 78 to 75, churns, builds a base, and then attacks 83 again with more fuel. Second path, deeper flush. Price loses 75, hunts, stops into the low 70s, scares everyone out, then reverses when sellers run out. Both can still be bullish long term. The difference is whether you are mentally prepared. And let us talk about the pattern everyone is whispering about. Two peaks near the same level, that M shape, the double top. On paper, it is a warning. Buyers hit the ceiling twice and failed twice, so bears start dreaming about a full unwind. But here's the contradiction that keeps the upside alive. In a real top, price breaks, and it keeps breaking. Support snaps like dry wood. Today, we did not see that kind of free fall. We saw panic, and then we saw a bid. Because what looks like a double top in a raging trend can morph into something else. Same shape, different ending. The difference is volume and follow through. If the next few sessions keep rejecting 80 and leaking lower, that is distribution winning. If dips keep getting bought and the tape starts climbing back toward the ceiling, that is accumulation wearing a disguise. So we do not worship patterns. We interrogate them. Fact, the ceiling held today. Likely, there are large sellers defending that zone. Possible, they are defending it to exit or defending it to reload for the next run. And if we are wrong, where will it show first? It will show at 75. If 75 cracks and buyers do not respond, that is the market telling us the handle story is dead for now. If 75 holds and we bounce with speed, the double top crowd gets trapped the other way. Now, here is the hidden engine behind a day like this. Stops. Most traders place their stop loss like they are all sharing one brain. Just under round numbers, just under yesterday's low, just under the breakout line. So when price spikes on a headline, late buyers pile in, and their stops stack underneath like dominoes. Then one sharp push down hits the first row. Stops trigger sells, those sells push price lower, which triggers more stops, which triggers more sells. That is not fundamentals, that is mechanics. A chain reaction, a controlled demolition of weak positioning. And the pros love it because it hands them discounted liquidity. They buy your stop with a smile. So if you are going to hold silver, we need to stop thinking like tourists. We think like operators. We accept that shakeouts are part of the trip. We size positions so we do not get forced out. We let the chart breathe because the only unforgivable sin in a bull move is selling the bottom of the shakeout and watching it rip without you. That is the pain they are trying to manufacture. Now watch the weekly close, not the midday candle. Amateurs panic at noon. Pros judge Friday. If we close the week above 75, the weekly candle can print a nasty wick but a healthy body. That tells the market we tried to dump it. Buyers showed up. If we close below 75, the market is saying, not yet. Again, not yet, not never. This is why our playbook is boring but powerful. We do not chase spikes. We do not marry green candles. We scale. We wait. We buy when fear is loud and liquidity is cheap. And yes, today's flush may be the market handing you a second chance. Because the crowd bought 82, the patient buyers are looking at 78 and 75. Now we also need to address the fantasy targets. You will hear 100. You will hear 200. You will hear 300. Targets are not maps. Targets are magnets. They pull attention. They pull emotion. They pull capital. But they do not tell you the path. And the path is where most people fail because the path includes days like today. A day that makes you question everything. A day that makes you want to do something. And that urge, do something, is the trap. Sometimes the best move is to stay still, to let the whales finish their work, to let the market digest, to keep your plan. Now here is the most important clue from today. Silver did not collapse into oblivion. It did not free fall and keep falling. It found buyers. It bounced in the 78 area. That is not a guarantee, but it is evidence. Evidence that someone with size is interested. And when size is interested, the story changes from crash to transfer. So here is our actionable framework. If you are already positioned and you're not over-leveraged, your job is simple. Do not get shaken out by noise. If you are under-positioned and you have been waiting, your job is also simple. Do not wait for perfection. Perfection rarely comes. And when it does, the crowd is terrified and you are scared to click buy. That is how it works. Now, we need a quick reality check. The bank's forecast, high 30s, sounds small compared to 80 spot. So why did the market react? Because most people do not read. They scan. They see silver and target and bank, and their brain fills in the rest. Plus, some reports talk nominal prices, some talk averages, some talk timeframes. The street compresses everything into one emotion, bullish. And bullish emotion is liquidity. That is why this trap works. It does not require accuracy. It requires excitement. So what is our takeaway? We keep it to 5. 1, headlines are often liquidity events, not gifts. 2, 83 is the ceiling until proven otherwise. 3, 75 is the level that decides whether this is a dip or a deeper shakeout. 4, time frame is everything. Do not mix long-term thesis with short-term leverage. 5, the narrative shift from institutions matters, even when the daily candle is ugly. Now, I want to open a loop you're going to feel in your gut. What happens next time we approach 83? Do they smash it again, or do they run out of ammo? Because that moment when the smash fails is when silver stops being a trade and becomes a headline that cannot be ignored. That is when FOMO turns from retail to corporate. That is when industry starts bidding. That is when paper selling meets real-world demand. And that is where things get violent. So here's the move. Watch the next 48 hours. Watch how price behaves around 78 and 75. Watch gold stability. Watch whether dips get bought quickly or slowly. Fast dips that bounce are strength. Slow drips that bleed are weakness. And if we reclaim 80 with force after this flush, the market is telling you the trap did its job. It shook people out. Now it can run again. One more thing we need to watch, because it reveals who is in control. The spread between paper price and real metal. If spot dips but dealers refuse to discount, that is not weakness. That is a shortage wearing a mask. If futures slide but delivery costs jump, the market is shouting that supply is tighter than the chart shows. We are not betting on a candle. We are tracking stress. So over the next sessions, watch premiums, watch availability, watch how fast dips get bought. If the market is healthy, buyers step in and the floor holds. If the market is sick, bids vanish and every bounce feels heavy. That is how we know what comes next. Before we end, you need one more warning. Volatility is a weapon. They will pump it and dump it back and forth to make you dizzy. They want motion sickness. Because a dizzy investor sells for relief. Do not sell for relief. Sell with a plan, or hold with a plan, but do not react. Subscribe now so we can track next smash. Before it hits, you drop answer below. Did you get trapped at the top, or did you wait for the dip? And where do you think the real fight is? 83 overhead, or 75 beneath our feet? Because the next candle decides who owns the metal, and the market is about to show its hand.